Welcome back to the channel, everyone. Today I want to talk about how US banks have cumulatively $168 trillion of unrealized derivative liabilities, and how, interestingly, this is a good thing for AMC. I've also got a few other key data points that I also want to update you on, so stay tuned and let's make some money. But guys, before I dive into the video, I just want to give a massive shout out to the 3,800 of you that have currently dinged that notification bell, because you guys are always the first to watch a new video as soon as it's released. So guys, be sure to drop a like down below, subscribe to the channel, and ding that notification bell if you haven't already, so that you don't miss another video just like this one. And just a quick one, if you haven't already, be sure to sign up with Moomoo to get 4 free stocks worth up to $3,350. But make sure you sign up and deposit at least $100 to get most of the free stocks. If possible, be sure to deposit $5,000 to get all 4 free stocks, linked in the description below. And now I want to dive straight in with the key information. So, if retail owns 80% of AMC, and Adam Aron actually confirmed last week in his interview with Trey's Trades that retail now owns over 80% of AMC's float, and institutions own 28.5%, then something doesn't add up. And here we can see a tweet from Garvin that says the AMC institutional ownership is now up to 28.5% of the float. Institutions now own around $5 billion of AMC stock. And this is a screenshot directly from the Bloomberg terminal that confirms that. If you didn't know, to get access to the Bloomberg terminal, the membership cost is around $28,000 a year for a sole party. Stick Stocks did some calculations and realised that 22 billion shares of AMC have been traded so far in 2021. I can't get over that. It's a simple numbers game. After today, the current float has been traded roughly 50 times this year. That's insanity. More fake shares than real ones at this point. Either you get this or you don't. Considering apes own over 80% of the AMC float, which is around 400 million shares, and haven't really been selling any of their shares, that means the remaining 100 million shares have been traded back and forth so many times that it's equated to 22 billion shares worth of volume. Either the hedgies and the institutions are quite literally paying hot potato with the remaining shares, or more likely, there's many times the float in existence in synthetic shares. We also have an update from Peter Han, the investment portfolio manager. He says, I keep seeing multiple media reports about AMC being a fool's trade, that it's being driven by Adam Aron, and he's leading a bunch of market inexperienced millennials to their doom. And when someone like myself joins in, clearly the old boy has lost it and drank too much of the Reddit Kool-Aid. I know you should hate the game and not the player, but quite frankly I find the outlets that put out this crap rather pathetic. There are many indicators that large institutions with serious pocketbooks and assumingly strong analytical research departments are jumping and buying AMC. Last week I mentioned that the Swiss National Bank had increased their holdings by over 300%. The latest 13F filings show that Renaissance Technologies LLC also increased their stake by 251%. This chart shows institutional buying and selling by quarter since 2018. As you can see, in quarter 3 alone, institutions have bought $2.14 billion of AMC, which is substantially more than any other quarter in the past 4 years pretty much. And now on to the meat and potatoes of today's video. Dark pool use by the top 4 banks increased by 38.2% in quarter 1 of 2021. Credit default swaps are up 3,437%. There's $168 trillion in unrealized losses in derivatives alone, not including naked shorts, synthetic shares, failed to delivers, and more. The CBO admits inflation and GDP to surpass its maximum sustainable value, I assume. Now, this is an absolutely huge post here by Boss Blunts. I'm not going to read the entire post word for word, as that would be very boring, so I'll just pick out the key information. But I will leave a link to this post in the description below if you do want to go through and read absolutely all of it, word for word. This began as an investigation into the correlations from 2008, 2011, 2013, and I think that should say the 2020 stock market crashes and debt ceiling issues. But it turned into my biggest nightmare, and there's no good outcome. Buy calls on my therapist, $65 strike price. As of the 1st of August 2021, we are entering a new debt ceiling crisis with Congress on a 6-week vacation, combined with an expired rent memorandum where 6.2 million renters face evictions. The homeowners of said tenants' houses will likely never receive back pay for rent owed, possibly causing record high bankruptcies akin to 2008 or worse. And without even taking this into account, the CBO projects a federal budget deficit of $3 trillion this year as the economic disruption caused by the 2020-2021 pandemic, with legislation enacted in response continuing to boost the deficit. As a comparison, in August 2011, during the debt ceiling crisis, the Congressional Budget Office, the CBO, projected that the federal budget would only show a deficit of close to $1.5 trillion, half of the deficit expected this year. For the period of economic expansion from the second quarter of 2009 through to the fourth quarter of 2019, real GDP increased at an annual rate of 2.3%. For the period of economic expansion from the second quarter of 2020 through the first quarter of 2021, real GDP increased at an annual rate of 14.1%, which in my opinion, and as shown by these reports below, is due almost entirely to the insanely high levels of newly printed money and stimulus payments, making it completely artificial. Disposable personal income decreased by $1.42 trillion in the second quarter, in contrast to an increase of $2.27 trillion in the first quarter, which is obviously fake gains through the stimmy. Real disposable personal income decreased by 30.6% in quarter two. Disposable means money that's considered non-essential, and it decreased by over $890 billion for Americans in quarter two of 2021 alone. But at the same time, personal outlays or expenses increased by $680 billion in quarter two after already having increased by $538.8 billion in quarter one. The personal savings rate, which is personal savings as a percentage of disposable personal income, was down 10.9% in the second quarter, which was already down 20.8% in the first quarter. This means Americans have lost $2 trillion in savings in quarter two of 2021 alone. The CBO said in July of this year, as the pandemic eases and demand for consumer services surges, real inflation-adjusted GDP in CBO's projections grows by 7.4% this year and surpasses its potential maximum sustainable level by the end of the year. Janet Yellen said that the US could run out of money using extraordinary measures by September, soon after Congress returns from recess, which means the US could possibly default on its debt for the first time in history. In my video yesterday, I showed you this website that shows that the US Treasury had around $351 billion in cash reserves and is losing around $20 to $30 billion each and every day. Therefore, it's likely that the US Treasury will be out of cash potentially by the start of September. On the 30th of July, the Federal Reserve announced commercial bank assets and liabilities numbers, and the liabilities have grown big time since last year. The Fed released commercial bank assets and liabilities numbers for July 2021, and they show year-over-year losses have increased tremendously in the hundreds of trillions of dollar region. A large majority of this is based on derivatives, call and put options, mortgage-backed securities, swaps of all kinds, rehypothecated shares, naked shorts, synthetic shares, and even more. 4 large banks hold 89% of the total banking industry notional amounts of derivatives, out of a total of 1,385 insured US commercial banks and savings associations. Those are JP Morgan, Bank of America, Citibank, and Goldman Sachs. Additionally, derivatives contracts remain concentrated in interest rate products, which represented 72% of total derivative notional amounts. The percentage of centrally cleared derivative transactions, being transactions that are cleared through the actual stock exchanges, increased quarter over quarter to 38.2% in the first quarter of 2021. That means 61.8% of all of their volume is being traded on dark pools. This is a chart that shows the total derivative liabilities without taking into account naked shorts and synthetic shares. This is effectively just the legal derivative liabilities. As you can see, the top 4 banks have $168 trillion in total derivative liabilities, most of those coming from interest rate swaps or just swaps in general. $189 trillion is the total derivative liabilities for all of the banks without taking into account naked shorts and synthetic shares, as well as shorts being marked as long that need to be covered, which would revert the asset back into a liability and therefore increase this even further. This table shows the credit equivalent exposures for the top 25 commercial banks. It shows the total assets, the derivatives, total risk-based capital, and more, effectively leading to the total credit exposure to capital. So you can see that the top three big banks and also State Street Bank here are way overexposed currently to their derivative positions. This poster reckons that sadly, many Americans will lose their homes, businesses, savings, 401ks, and likely more so than in 2008. This could lead to the collapse of the dollar if the government defaults on its debt for the first time, possibly the collapse or rise of crypto, potentially war with China, issues with the Middle East, BlackRock and corporation taking over land and all of housing. I want to go back to the title of this video because I think it summarizes the post the best. The dark pool use by the top four banks increased by 38.2% in Q1 of 2021. Credit default swaps are up 3,437%, and there's $168 trillion in unrealized losses or unrealized liabilities in derivatives alone, not including naked shorts, synthetic shares, failed to delivers, and more. These massive debt levels, overvalued companies in the S&P 500, and the debt ceiling crisis is all leading to one thing, which is the major market event. When this all comes toppling down, this is going to lead to major liquidations in major banks and major hedge funds. Major liquidations is going to mean those short positions have to be covered and their long positions have to be sold off when they get liquidated. Yes, the long positions can be lent to the DTCC in exchange for cash, but short positions cannot be lent. Therefore, short positions have to be covered. Considering that short positions have to be covered, this means that their AMC short positions have to be covered and they have to go into the market and buy real shares of AMC to cover their positions. This effectively means buying stock from us apes at any price we set. Any price we set. And finally guys, if you didn't already know, I'm currently holding a $600 giveaway, drawing the winner on the 28th of August. To be in with a chance of winning, all you have to do is join the Patreon, linked in the description below, and you also get a bunch of other benefits while you're there as well. I give my team urgent news and due diligence and updates about AMC and other stocks before I even make a video, and you're always free to ask me and anyone else in the team questions whenever you might have them. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.